What a great panel, and it's good to have all of you here. And as we think about the value chain or supply chain of securities that are going to be digital and trading on a destination like SDX, there's a number of players that need to be involved, from tokenization through valuation and through the original product itself, right? And so I think what I'd like to do is if we can just have everybody introduce themselves and maybe take a moment to talk about what you do, and maybe Daniel, we can start with you.
Well, I was on panel yesterday, so I'm going to obviously skip that part. I'm one of the co-founder of Tokeny, responsible for business development. You heard about Tokeny those last days, so and I can provide a couple of examples of what we've been doing in real estate lately.
Good morning, I'm Declan King. I'm the MD and Group Head of Valustrat. We are Inveniam's partner in valuation in the Middle East, and delighted to be here today.
I'm Nadav Zohar, LRC Chairman. LRC is an asset manager. We manage multi-billion euro portfolio across Europe, UK, Ireland, Germany, France, and Poland. Wonderful.
And Nadav, you've been leaning into digital for quite some time. You've made bets. You've moved your company into digital. Talk to us a little bit about that journey for you. What first got you going, and how did you identify the value that you wanted to pursue?
Sure. So I've been around real estate and fundraising for 30 years, and I've always experienced the manual nature of the transactions. If you want to buy real estate, if you want to securitize, if you want to raise funds, if you want to put tenants into the building, it's all a very manual process. And the view was that the cost of that friction is exorbitantly high, particularly when interest rates and yields were compressing, and they just became a significant overhead on the entire value chain. So we started breaking it down into components and just removed friction from each and every part. And one of the key areas in fundraising for real estate is that it takes 9 to 12 months to raise a real estate fund, if not more. If you're dealing with pension funds, it's bilateral, every deal for itself. Every fundraising has its own fundraising document, and it's all very, very bespoke. I think the critical path that we all need to follow is reducing those friction points and removing them from the equation, just making the whole thing much more standardized, transparent, and allow people to just select where they want to invest in, rather than really entrust all of your money to a single ETF or a single fund manager that will do it on an opportunistic basis. And with huge overheads. If you think about the current status of how do I get my dollar invested and how do I get returns back, 50% of your cash flow goes to pay intermediaries. It's insane.
And as you, as a real estate owner, are going into this, you talked a lot about efficiencies. Talk also for a moment about liquidity. And seeking efficiencies operationally, administratively, but also talk a little bit about some of your hopes and goals around liquidity for existing investors and new projects.
Okay, so for existing investors today, liquidity really comes in the form of selling the assets and distributing it to the original investors. And that's probably the only way. Sometimes you can IPO a platform and maybe you can list it and somehow gain liquidity through secondary trades. But really the only option for people buying real estate is to sell the real estate in order to gain liquidity or receive some income from it as a going concern. I think that what we're trying to achieve, and I think as an industry what we're trying to achieve, and this is across all spectrums. If you look at Blackstone's KKR, if you look at Lone Star, Cerberus, all are looking at ways of actually increasing the liquidity pool by tapping tapping funds that are not necessarily pension funds, which is traditional way we would raise money to buy real estate. So if you look at private wealth, family offices, the only resort they really have if they want to do granular real estate investment is to go to buy the buildings themselves. That's extremely inefficient. The leakage from gross to net is too high. So what we want to offer them is the ability to actually tap anything from a single building to portfolios to multi-country portfolios based on specific strategies, and be able to do it in a standardized form, very cheap, cost of transaction, and allow them to then secondary trade it almost immediately. So I think, where do we get that liquidity? We get that liquidity from family offices, from the retail market, and from pension funds who are, also restricted today in accessing the market through, maybe 6 or 7 channels per pension fund.
And LRC, you made a very distinct bet when you became chairman and co-led with JP Morgan the investment into Onera, right?
Yes, and we looked for different platforms, and really we had 2 choices to make. We could go to an exchange, which was a walled garden approach, and just say, look, we'll put the real estate with you, and we'll rely on you to get us investors onto your platform, so we would be restricting our liquidity to that platform. And we couldn't find a platform that would really give us the liquidity size that we wanted. We wanted to bring, 30+ billion of assets onto the platform, and to get that type of liquidity, we came to the conclusion that the only way to do this would be to really tap the big banks, because they would give you the validation, they would give you the regulatory oversight, and we wouldn't need to reinvent anything. So Onera gave us that ability to tap into multiple organizations across all asset classes, and we didn't mind the competition.
Beautiful. Declan, Valustrat has a wonderful franchise in the Middle East. You've been publishing indexes for real estate in the Middle East for some time by country, and you have a wonderful franchise in infrastructure. And recently you came into the UK with an acquisition, and so you have a nice franchise here as well. Tell us a little bit about your legacy business before we talk about your move into digital.
Okay, so as everybody would know, the Middle East is home to some of the biggest projects in the world, incredible, tall, largest real estate developments that one will find. And as a valuation company, we would value such projects, so they would be master plan communities, the tallest towers, the biggest hotels. And these developments are undertaken by government-owned developers, by private developers, and by incredibly wealthy family offices. So just like valuation companies here in the West, we would undertake our ICS Red Book valuations. We're a regulated firm, and undertaking those by way of normal valuation methods. So very like the relationships you have here, Pat, but very big, chunky assets.
Gotcha. And as you did this, you also began a number of years ago creating some indices.
Yes. So I joined Valustrat in 2014, and we set up the research department. And research departments are fantastic for valuation companies, particularly valuation companies that exist in lands of very restricted data. So if you come to the UAE, which is a confederation of 7 separate emirates, there actually is only official transactional data in one of those 7 emirates. If I bring you to our office in Saudi Arabia, there is virtually no official transactional data there. And a similar story in Qatar, and absolutely no data in places like Kuwait, Oman, Bahrain, and other countries in the region. And any valuers that are here in the room today will agree with me that the lack of official transactional data it's a very real impediment to undertaking accurate market-reflecting valuations. So what we did was to try and shine a torch on those dark spots, was to create our own stable of proprietary valuation-centric indices on several different asset classes across those countries. So we've created indices in the resi sector, in the office sector, and most recently in the logistical sector, just to give investors and give market participants some insight on those spaces.
And as you leaned into you had a data orientation, but as you leaned into digital data ingestion, digital data variance from previous mark, right, where you were automating that. Talk to us a little bit about that. We, for full disclosure, we jointly are doing some work for one of the largest sovereign wealth funds in the Middle East. Talk to us about that digital effort and how that's helped you and improved what you've been doing.
So as a valuer, when you're tasked with valuing some of these large giga projects, you receive your data from your client in very different ways. Some of them are incredibly organized, but some of them are surprisingly very disorganized. And as a valuer, we want our staff to get to the valuation part as quickly as they can. But we find that, unfortunately, valuers are often left spending days sifting through information. So that could be lever arch files of paper documents. It could be very disorganized PDF folders. It could be very difficult for us to get to the passing rents, the lease renewal dates, the operating expenses, the type of information we really want to get to quickly, Pat, so that we can start the valuation process. So what we have found in our partnership with Inveniam is that we can get to that point more quickly. So instead of having to sift through multiple very complex attachments, instead of having to sift through lever arch files of paper documents, we can get to that point faster, so our valuers can undertake the valuation more quickly.
And I'm gonna take this and directly lead it into Tokeny in just one moment, but let's use an example with no names, right? We did a valuation work together, call it 5.5 billion dirham, right?
Correct.
About, that's 1.25
pounds. A billion pounds, more than £1 billion.
Yep. A portfolio of, low double-digit properties that we put together. And talk to us about the metrics of the amount of data they gave us and the time frame and your ability to turn that information around.
So the subject assets were 4 CBD office blocks in a CBD area of one of our prime cities. We were looking at a valuation amount of over £1 billion. And these office blocks had, I think it was 300 to 400 occupants. So a complex enough assignment. The assignment, I think we had expected, would take us something approaching 8 to 10 working days. And from memory, we were able to turn that around in less than 5 days. So it certainly hastened the valuation output.
And one of the things that I want to highlight is that they did a competitive bid where there was a third party that was their historical valuation provider, that they gave them 9 weeks to turn their proposal around as an alternate mark versus you, where we received the documents and turned the data in 5 days, which is pretty fantastic that you could ingest it, receive it, and turn that mark. And this speed of valuation where you can start to set marks monthly on these assets, where you're seeing the change in the core documentation and the change in the KPIs, suddenly you're able to set a mark on that asset, which then we can have a change in the value of the capital stack, which then you tokenize, right? And talk to us for a minute. You were born as a digital entity, and you have tokenized 28 billion, roughly. Is that right? Am I saying that correctly?
That is correct.
Talk to us about how much of that has been real estate, and as you tokenize, and those are pieces of the capital stack in real estate, the equity, the mezz, the senior, what does that look like, and what progress have you made to date as a digitally native company?
Well, from the 28 billion, first of all, it was driven by limited numbers of clients in the Asian region. I would say around 20% are real estate. In the process of tokenization, and maybe allow me to state the obvious, but you cannot tokenize something that is not digital. And very often, we have people coming to us and they want to digitalize real estate, and they want to digitalize the real estate itself, right? So you digitalize the ownership. And when you do that, the obvious first step is to look at the project as a whole. Very often people are coming to us as the first step towards the journey towards tokenization, where we're telling them we are the last step. So the fact that you are tokenizing your assets does not mean that you are creating something different in terms of asset on how you wish to structure it. Actually, if you look at MiCA, we've been mentioning that a couple of times, MiCA defined what is a digital asset, and from that, it excludes specifically financial instruments, so you need to abide to MiFID. But you also need to abide to corporate rules. You need to abide to tax legislation. So all that is part of the entire scope of the project that you need to structure properly. So you have to look at where the asset is, you need to look at what is the type of instrument you want to issue, will it be debt, will it be equity, convertible notes, whatever. So this is a normal structuring. At the end of the day, tokenization is again the last part of that journey, which is to represent it on a different infrastructure that allows different type of value-added services that will come with the time, including creating paths towards liquidity. So that journey started with the ICO ages. I know it looks like a long time ago, but that journey was interesting because, first of all, it was the first time we were using smart contract. If you remember, it's Fabian Vogelstelder that invented this ERC20. And this ERC20 is nothing but DVD, deliver versus payment, deliver versus delivery, as we call it, because it's not really payment. And this was the start of the journey, and it was done at that time with Ether, with Bitcoin, with altcoin. So we built at that time the capability to already do on-chain settlement, which obviously now is moving forward very fast, and we hope that we will have stablecoin very quickly. But I do believe that in what we're doing now with tokenization, part of the value that we are going to create, especially to real estate, is of course to create a journey towards liquidity, although bluntly said, you don't necessarily need a token for doing that. You are already doing that on exchange. So I think that here with tokenization, we're expanding the numbers of assets that we are going to bring to those exchanges. But more importantly, I think that there is a lot of admin that relates to those assets that will be made more efficient. Transferring assets is a very complex process. Accessing the data to that assets to look at, what are the terms and conditions applicable to the transfer. At the end of the day, when you create a token, the first thing that you do is to increase the transferability. That can lead to liquidity, but it's the transferability. So think about all those assets that are highly illiquid or unmovable, right? And the capability to start programming rules to ease the transfer of those assets and replace all this paperwork by smart contract where a lot of those rules will be programmed and enforced automatically when you start engaging into this process. So probably the low-hanging fruit will be coming from that. And then as we start building the ecosystem with more liquidity solution and more interconnection between those liquidity pools, will we start seeing a journey towards more liquidity.
And I want to talk here for a minute, if we can, about maybe two different things, and then I'll ask the panel a question and allow each of you to answer the question yourself. But I want to draw a distinction between when there's a conversation around tokenization, many times it immediately devolves into a discussion of the technical, right? What chain are you on? Is it permissioned? Is it permissionless? How are you solving custody, et cetera? And there's an assumption that is on what the legal structure is that token actually represents. And those assumptions many times are where the devil and the Holy Spirit reside, right? In the details around that. And in the U.S., when people say, what system are you on, and what's the underlying operating system that Inveniam relies upon from a chain perspective, I like to say it's the Chancery Court of the state of Delaware, right? Because that is the fundamental reality. The token represents a legal thing that is resolved juridically, that we're allowing for the administration, trading, settlement more effectively of that thing, that is a juridic thing. And then what it sits on, many people use permission chains within a closed loop banking. Onera has a very good franchise on that. Tokeny is on a permissionless EVM solution, which is a more direct to the consumer solution that is different. And you can argue one is a local area network, one is the internet. You could argue one is a regulated, one is but the point is, we are such early days on this technology that if we can have clarity with the operators on the legal structure that all the participants can understand, the market will determine the technology, right? And we'll figure that out collectively. But I think one of the things that I want to ask as we talk about this, both legal structure, what is the thing being tokenized, how is it traded, how is it administered, how is it served? What I want to hit is, what are the next steps for us as participants on the stage, but then also for the market, for real estate to start to see real buy-in here? And what are those? And Nadeem.
Sure. So, look, I think I wouldn't make too much of a big deal out of it, because I think we've sorted it out. I think we'll show the market very early in the next few months. You will see the first products coming out. So from a legal perspective, we've designed a system that works within the existing regulatory domain. Over time, as regulations evolve, it'll become less and less cumbersome. But it's not that cumbersome at the moment. I think at the end of the day, just to give you a very brief overview of how it works, is that we are creating a class of shares, a digital share class, that is representing an economic right in the asset. That is essentially represented as a token, and many companies can tokenize this. And what's really important to the distributors, whether it's banks or others, is that this economic representation is capable of being collateralized, right? So if I'm actually offering you a loan, I can actually take it over, and it represents a real asset. So I don't think we're in a place where we're nascent in any way. We've solved it, we've cracked it, we've used all the top law firms globally, in Europe for sure, and the US it's also been resolved. So we know the structure, and we're using it within the existing domain. If there's tax to be paid, we pay tax. If there's stamp duty to be paid, we pay stamp duty. Obviously, we're trying to design it so that the frictions are removed where possible through the right structuring. But I think over time, what you will see as countries evolve, and land registry has gone digital, and you will see continuous evolution towards making those representations, digital representations of assets, more and more prevalent.
We're having conversations right now in the GCC where in 2 countries that are granting crypto licenses, right? They've asked, where we're talking to the central bank, where they're saying, listen, crypto, great, but we will give you the crypto license if you will tokenize the real estate and have it trading in a tokenized form prior to your crypto being traded on your platform. And they want to push that more than and the regulators are pushing this. This is a strategic goal that we're hearing, and this is across multiple jurisdictions in the GCC. Talk to us a little bit about that.
I think you're absolutely right, Pat. So the central banks in the Middle East, I think, are pushing an open door. They're happy to be innovative and future-looking. And I certainly would say the same for our heavy real estate-heavy corporate clients. When we, with Inveniam, introduce the solutions to them, I think it's an absolute yes. They do see tokenization as the imminent future. And I think all it will take for them to get on the board that train really is to see somebody do it first in an exchange that they trust, see it be successful. And I think we'll find our biggest developers will use it as a pathway to selling their real estate. And I think importantly, what a lot of them like is that they can still retain ownership in the asset, but tokenize the income stream. And we have found that to be a very interesting sub-nuance of this conversation. Because in the Middle East, clients often like not to sell. They like to build and hold. Some of them have a build and sell approach, but some of them have a build and hold approach. And tokenization, I think, is very interesting. It can still fit in there to help them offer the income streams to the public. And obviously with the public, it means that they can sell to those who otherwise couldn't afford to access that asset class, who otherwise couldn't afford to access that type of income opportunity.
And the supply chain for this to be a reality end-to-end is the accounting treatment needs to be agreed upon. And so on Inveniam, we have KPMG, we have EY, we have Deloitte, one of our key partners, we have Cushman & Wakefield, we have JLL, we have CBRE, we have Valustrat, so that people can say, yes, there's a good mark. Yes, the accountants are going to sign off on this because the accounting team themselves are in the system looking at the data real time, and we can deliver that and connect it up to the token that's been created. And so talk to us, Daniel, a little bit about the inbound conversations and calls that you're having, and differentiate the last 6 months versus the last 6 years about kind of that flip that you're seeing.
Well, obviously the biggest shift is definitely with regards to the underlying infrastructure. I mean, your previous question was related to that, what will be the infrastructure? I think it's irrelevant at this stage because market always dictates. If you remember, for those of our age, there was a big debate about using VHS versus Betamax. Everybody knows that Betamax had a better standard, but VHS won because the porn industry decided to select the VHS format to distribute its content. So we saw a shift in this market adoption because I think that people start to realize that what will be driving the next wave of developments is innovation. And innovation cannot happen in silos. If you start building in silo, you will prevent yourself from accessing innovation. And financial institution has been working on legacy technology solution for years because they couldn't close the shop and say, come back in 5 years, I will upgrade my technology. So they've been patching their system, having through acquisition multiple information system that they had to maintain. I spent part of my career at Clearstream Banking, and it's between us, but I think that Clearstream is spending around 100 million every year in maintaining its infrastructure. They had to call back people that were retired because there were patches that they didn't know how to basically fix, right? So here we have a new infrastructure that enables us to build new services, and this is what will be driving this, the choice of technology. And definitely what we've seen lately, for sure, and what JP Morgan has been doing a couple of weeks ago in Singapore is the dividends of that. And by the way, I want to add as well, because few people know that, because we all talk about regulators being, a bit, not favoring public chain, but the BaFin has been stating that they will not assign digital license to providers operating on networks that are not sufficiently decentralized. So public blockchain so far has been accepted. Ethereum and Polygon, private chain are excluded from getting any digital asset servicing license.
And maybe it would be a fun viewer discussion about public versus private, but I don't think that's what we're talking about here. But it's important. The devil and the Holy Spirit are in the details, right, of this. And as we think about this move forward, we have an enormous amount of large participants who are here where we can talk about, and I'll just kind of maybe wrap this up and then let everybody have a comment. But, with Inveniam, our clients needed to see how does this interact directly with our general ledger, right? How does this interact with the waterfall tools that we have? How does it interact with valuation? How does it interact with the administration and ongoing reporting to our LPs? Before we can have the discussion of where is the token going to be issued and where is it going to trade, right? And so now that this back end is filled, the people are beginning, and they're seeing that there's not 100 million, but that there's 50 billion, 60 billion, 70 billion of this, where there's total administration end-to-end digitally of that asset to all the various different computational tools, delivering that to a digital representation of the capital stack suddenly becomes a reality. And so what are we going to see, this is my question, what are we going to see in the next 3 to 6 months that are going to raise people's eyebrows? And Daniel, I'll let you go first and we'll go out this way.
Well, I think that what Inveniam is doing, which is really enabling the assets to be fed with evaluation, is obviously the first step towards having secondary market. If you cannot assess the value of your assets, obviously there will be no secondary market. So what we see happening is more and more application sitting on the infrastructure. Again, to make the analogy with internet, you didn't have Facebook and Instagram before having the internet. And we really see the same thing now. People realize that there is an infrastructure on which you can build application, and you can pick and choose the service you want to add. You want to add valuation, you add valuation. You want to add secondary, you add secondary. And you decide how you create more value for your clients.
Beautiful.
In our part of the world, over the next 3 to 6 months, of course, we'd love to see more transparency on the regulation and the intention of those involved in that path, so that clients can actually see a route to tokenizing their assets. And obviously, as valuers, we're delighted that regular revaluation is at the absolute core of that.
I think on the asset side, we'll see multiple assets coming on in digital form and becoming available to the private wealth and family offices. So qualified investors will suddenly have access to new asset classes that they haven't been able to invest. I think on the key driver of that is going to be essentially a uniform digital wallet that will allow you to have all of your securities in one place, whether they'll be public securities or private securities. They'll all be there, they'll be fully transparent, and they'll have the data layer that Inveniam will enrich with the help of the valuers and the marks. And that will be the benchmark for risk managed and well thought through asset allocation through a digital wallet.
Thank you all so much. Thank you.